Okay, let's get right into it. Today, we're going to talk about a particular 3.8% tax, one that has a funny way of sneaking up on successful investors and high earners, often when they least expect it. If you've got investment income of any kind, you're definitely going to want to stick around for this.
So let me just ask you this straight up. Is it possible you're paying a hidden tax on your investments without even realizing it? It's a real question because this tax isn't your standard income tax. It's an extra layer that gets stacked right on top, and for a lot of people, it just flies completely under the radar.
And there's the number, 3.8%. This is the rate for something called the Net Investment Income Tax, or NIIT for short. It came into play a while back with the Affordable Care Act, and the whole idea was to have high-income folks contribute a bit more to Medicare from their investment earnings.
Now, here is the absolute kicker, the detail that makes this tax more and more relevant every single year. The income levels that trigger it, they are not indexed for inflation. They don't move. So as incomes rise and investments grow, more and more people get pulled into its orbit. It's what you'd call a classic case of bracket creep.
So, here's how we're going to break it all down. We'll start with what this surtax actually is, then we'll get into the big question. Do you owe it? We'll look at how it's calculated, and then, the most important part, we'll explore some really smart strategies to manage it and create a proactive plan.
All right, so first things first, what is this tax, really? As I said, it was born out of the 2010 Affordable Care Act, and its main job was pretty simple, to help fund Medicare by tapping into investment income, which hadn't been targeted in the same way before. You'll notice the official term for it is a surtax. That's a really important word here. It means it's an extra tax. It's layered on top of whatever else you're already paying, like your capital gains taxes. The IRS even gave it its own special form to deal with, Form 8960.
Okay, now we're getting to the question that probably matters most to you personally. Does this tax even apply to your situation? Let's take a look at the actual numbers.
This thing kicks in if your modified adjusted gross income, or MAGI, goes over these thresholds. MAGI is basically your adjusted gross income with a few deductions added back in. For single filers, that line in the sand is $200,000. For married couples filing jointly, it's $250,000. And just to say it one more time, these numbers are set in stone. They do not go up with inflation.
Now, if you find yourself over one of those thresholds, you might think, okay, simple, I just pay 3.8% on all my investments. But nope, it's actually a little more complicated than that. You've got to understand this really crucial part of the calculation known as the lesser of rule.
Before we get to the rule, we have to define one of the key players, your net investment income, or NII. All this is your total earnings from investments, but then you get to subtract any expenses that are directly related to them, like, say, investment advisory fees. And what kind of income are we talking about here? Well, it's a pretty broad net. You've got all the usual suspects, of course, interest, dividends, capital gains. But it also includes things like rental income, royalty income, certain annuities, even income from a business that you're a passive owner in.
And here it is. This is that lesser of rule in action, and it is a game changer. You only pay the 3.8% tax on the smaller of two numbers, either your total net investment income or the amount of money your income is over the threshold. This is actually a huge relief for a lot of people because it can seriously limit how much of your income is actually hit by this tax. Okay, so we've covered the what, the why, and the how. Now for the really empowering part. What can you actually do about it? Let's dive into some smart, totally legal ways you can get ahead of this tax and reduce its bite.
All right, for all of you with a lot of your portfolio in real estate, this first strategy is a potential grand slam. It's not easy, but if you can qualify for what the IRS calls real estate professional status, you might be able to make your rental income completely exempt from this tax.
But, and this is a big but, the requirements are really strict. You have to pass two major tests. First, more than half of all the work you do in all your jobs combined has to be in real estate. Second, you have to log more than 750 hours a year in those real estate activities. We're talking serious commitment and meticulous record keeping. But wait, there's actually another layer here. Just getting that real estate professional designation isn't quite the final step for the NIIT. There's this extra rule, a safe harbor. If you can show you spent more than 500 hours specifically on your rental activities, then the IRS agrees that income is from an active business, not a passive one. And that's what gets it excluded from the net investment income tax.
All right, let's switch gears to strategy number 2. This one is an amazing fit for anyone who's sitting on highly appreciated assets, think stocks that have done really well or a piece of property that's gone way up in value, and who also happens to have a charitable streak.
It involves a tool called a Charitable Remainder Trust, or a CRT.
So, what the heck is a CRT? Well, think of it as a special trust that does two jobs. First, it pays an income to you or someone you choose for a certain amount of time. Then, when that time is up, whatever is left in the trust, the remainder, gets donated to a charity you picked.
Now, the tax benefits here, they're just incredible. You get a tax deduction right away for the gift that the charity will eventually get. The trust can then sell your asset without paying any immediate capital gains tax. And here's the direct connection for us today. The trust itself is a tax-exempt entity. It doesn't pay the 3.8% NIIT.
I mean, just look at the difference this can make. Without a CRT, you sell your stock, you take an immediate hit from capital gains and possibly the NIIT, and you're left with a smaller pot of money to reinvest. With a CRT, you put the stock in the trust sells it tax-free, and the entire amount gets put to work. A bigger principal means a bigger potential income stream for you. It's a huge difference.
So, after going through all of this, what's the big idea? What's the final takeaway you should be thinking about for your own financial plan?
I think it's this. The net investment income tax isn't just another bill to pay. It's really a signal. It's a signpost on your financial journey that tells you you've reached a level where your strategy needs to evolve. It needs to be just as much about being tax smart as it is about just pure growth.
And that's really the heart of the matter. The whole point here isn't to be scared of this tax. It's to understand that if you have the right knowledge, if you plan ahead, the NIIT stops being this scary, unavoidable burden and instead becomes just another manageable piece of your overall financial puzzle.
So, I'll just leave you with this one final thought to chew on. Is your financial plan really built for tax efficiency? Or is there a hidden opportunity there to be more strategic, to be more proactive, and ultimately to keep more of your own money working for you?